Global equity are in a bull mode. Any warning sign? Well, we remember that 2 weeks ago, we were looking for a buy the dip opportunities, possibly holding within our red dotted line triangle. Well, the reality was we didn't get another dip, and the break up of the triangle took place immediately a few days later. Now, all markets globally are in bull mode, and what we want to see is what's the targets, when it will reach the targets, and if there is any warning signs. In terms of the targets, what we've got is the green path suggesting, based on the width of the triangle, from 3027 to about 2800, a target of 3200. 3100, which is the bottom of the target zone, can be reached by the end of the year. And during the first quarter of 2020, we can see most probably 3200. As we see also, this first quarter top could be reached at the time where we meet about the apex of the old dotted red triangle. Momentum is strong. The relative strength of the technology on the Nasdaq, which has been leading the market so far, remains up. It's about to make higher highs. Obviously, such a strong rise brings the weekly stochastic or momentum oscillator already in the overbought area, but that is, after a breakout, a sign of a strong market and not a sign that the market can pull back deeply. And we see that the momentum of the MACD for the long-term uptrend is now positive. So short term, of course, it's very difficult to figure out at what point, at which levels there will be a small pullback. What we noticed recently is we had two types of gaps, one at 3040, 3050, and another one a little bit above 3070, 75. Probably one of the last gap will be filled up relatively soon, with some consolidation going all the way back to 3060 at most. And then the resumption of the uptrend late November and December. So that's what's going to happen. We notice that this is happening with the VIX in orange dotted line being relatively flat, so no warning signs. People really are realizing that this is a break out of this blue triangle and that the rise can be very linear. Secondly, we noticed also that this has happened as the green line here, which is the US 10-year yield, is trying to make a double bottom or activating a double bottom above 190. And that corresponds to the scenario that we mentioned, where we had a rotation from growth to value last 2 weeks, especially nurturing the fact that if long-term rates are moving up, that's probably also going to favor financials. But we mentioned that last time. What we want to see now is what would be the warning signals if something doesn't go well for our bullish case toward 3200. The first thing that we notice is we are back here on the US 10-year interest rates, is to notice that we are at 190 at a relatively sensitive point. That means this is a resistance which corresponds also to the upper Bollinger Bands here in red at 186, 190. It needs to be broken up and activates really the double bottom. It will not go so fast up. I don't think it will reach 2014 before year end, but it could move in a way like it is represented here on the chart, first to 195, 2%, then a pullback, and then later on reaching the former high of 214, which was the level we had in July already. So a failure to break above 185 would be a concern. The second level where we would have a problem is from the currency side. We remember that when the market were within the triangle and when there was some deep pullback within the triangle, the risk off mode was activated when the yen was strong and the Swiss franc was strong. And here we have the yen index, and we see that since August, basically, we are in a downtrend. It's going step by step. It's not going very fast, but well enough. And it's expected to break the 91.50 towards 90.50. We notice that this decline of the yen has also helped the relative, the Nikkei pull back on its former descending trend line and go to higher highs. So what we want to see is really what happened to the yen index later. That means, when I mean later, that means when the yen is going to touch the 90.50 levels, which is also this support rising trend line in orange here. That will be a decisive moment, because if the yen at that time rebounds, and that will be the warning signal, then it's probable that the Nikkei will be stalling just below the 24,000 level, 24,500. And that could spell a little bit of trouble. We would see that then in the relative strength, in the black dotted line, which is making higher highs and higher lows, and would stop to do so in the end of December or something like that. Another place of concern is related more to Europe. Here we have the Swiss francs, and we know that the big downtrend here is a strengthening of the Swiss francs versus the euro. And here we had a kind of a double bottom. A first test of a 110.40, a second test right now. And it's taking time. It's not really wants to activate so fast, this double bottom. And this double bottom has, of course, a target toward 112 and possibly higher. But at least we have a first resistance level at 112, and then it could go to 114 if we are very aggressive. But we are a little bit disappointed that it has not yet already broken up. And we would keep an eye on that, because if it failed to do so, that means there is probably a risk to go below 109. And if it's the 109 level is broken, that would put into question the risk on mode, or say that something is wrong about Europe. Maybe Brexit or whatsoever, but something is wrong about Europe. And that's what we are going to look also in the European indices. Here we have the ASU ETF, which excludes Switzerland, which is relatively defensive market, and the UK, which is very much related to Brexit. So we want to have a view isolated from these two aspects. And we see clearly that the relative strength of Europe versus S&P 500 is bottoming, but it is taking a lot of time to move up with higher highs and higher lows. So once again, Europe, which can outperform during 1 or 2 weeks, suddenly after 2 weeks of outperformance tends to pull back or tends to slow down a little bit in its relative outperformance. So here, from a nominal viewpoint, of course, we've made a break above the triangles also for European markets. It has resistance a bit higher, about 3-4% above, and it will join the former highs that we've got close to the beginning of 2018, and eventually the spike at 44.50, which is about 10% higher than current level. And we see also that the DAX, here is in orange dotted line, had been moving up after the fourth attempt and broke up. So here, everything is fine. What we want to see is an improvement of this relative strength black line here in the coming weeks. Because momentum is already overbought, any failure to do so would then reflect on an incapacity for a further advance or just a sideways move for the European market. Then we've got the rest of the world. And the rest of the world was in bad shape, and we have here this relative strength of emerging markets versus the S&P 500 since basically 2018 here. You see here the top at 50.5. And this underperformance of this emerging market is coming for a change. It has changed already a little bit at the end of 2018 when the market, the S&P, was correcting quite strongly at the end of 2018. Here it is a different situation in the sense that the S&P is moving up, but we see also the relative strength of emerging market versus S&P 500 is bottoming. And depending on which market you look at, Russia or Brazil or eventually China, the outperformance is not exactly the same, but the news are relatively good recently, and we noticed that it has also broken this symmetrical triangle here. Here is a breakout 2 weeks, 3 weeks ago, and we are just joining some resistances. And these resistances are related to the former high at 44.50 and the Bollinger Bands. And contrary to the S&P 500, you notice that these Bollinger Bands are still flat and we have not broken that upper bands already. So here we really need to see an improvement, a further improvement of the relative strength of emerging market versus the S&P 500. And we need to realize that rising rates here in the green lines, rising US 10-year yield above 190, if it rises too fast, that could also be a hindrance for emerging market. So we have here all different kind of warning signals that we can look at. Meanwhile, all global markets are in bull mode, and that's good news. That corresponds to the seasonality from November to March. We'll talk to you next month.